What will you do when your money works for you? Welcome to the Tech Girl Financial Podcast with your hosts, Victor and Kim Gaxiola. From the home office in California, here is Victor and Kim.
Welcome back and happy holidays. We are just days away from the end of the year. And we have some end of the year planning deliverables to give to our audience and listeners. And once again, we just thank you for being a part of our podcast through the year. And we hope to have you again with lots of amazing content next year. So we have today our special guest, Cheryl Red, of BeIncredibleCoaching.com. So if you notice in that, Cheryl is spelled with a C and her last name is Red, R-E-D. And the letter C and Red are part of the word incredible. Mm-hmm. And this is our special guest today, Cheryl Red, a friend of mine, and I'm so happy to bring her on to talk about some end-of-the-year strategies for charitable giving.
Yeah, and you've known Cheryl for many years. Met her when we were still living in Illinois. I think she was an advisor at one point, which we get into a little bit in the beginning, and it was so exciting to have her on the show.
Yes, and through the many, many years that I've been going back to Chicago to visit with clients, I always tried to fit her into my schedule as well. And, you know, I think every 5 years I managed to get in and have a dinner with her, which is so enjoyable.
So in the spirit of giving, here we are as we're approaching the end of the year. And of course, just coming off of the holidays, we're all feeling good, warm, fuzzy. Let's give more. I think we can all give more of ourselves, but give money. And here are some very good ideas that Cheryl's going to share on how you can think about providing for charitable contributions in a very smart way. So without further ado, here's our interview with Cheryl.
Hello, Cheryl. It is such a joy to have you on this podcast with me today. For those of you who don't know, Cheryl and I have been friends for a long time, ever since we were networking in our women's group back in, where was that? In Algonquin, Illinois, right? So I want to introduce Cheryl here today with Be Incredible. And notice if you saw her logo right now, you would notice that in Incredible, it has the letter C-R-E-D, and that stands for Cheryl Red. So welcome.
Thank you very much. Actually, I was thinking you were saying when we met, do you know, I think it was the year 2000, maybe 2001. So it was a long time ago. You and I were both just starting out as advisors. So yeah, it's crazy how our lives have continued to bring us together again.
It is crazy. And I just remember, I always tell this story with you that you and I had a good connection back then, but we didn't really talk to each other very much because we were competing. And so you were at Northwestern Mutual and I was with A.G. Edwards. And while we wanted to probably have more conversations together, we were just getting to know other people because that's what we did when we were networking.
Exactly. I know. And we were, and I would sit back and I'd watch you. You were never afraid to get up and speak. And I was sitting back and watching. I think you were probably a couple steps ahead of me as far as in the career path. So I was kind of watching you and thinking, yeah, that's what I need to do. But anyway, so yeah, you're right. We were sort of competitors, but we were sort of, I don't know. I was admiring from afar. So I'm glad we're not competing anymore.
And yet it's interesting because we only just met today. Okay. Even though I've known of you for so long, it's so great to have you on the show. Happy holidays, by the way. Hope you had a great holiday. And also just wanted to say, I think the fact that you two met almost as competitors, but now have continued a relationship and nurtured that relationship over, the many, many years, like near 20 years, speaks a lot to this community, the community of the advisor community, the people who work in financial services who are very like-minded in singular in their mission and wanting to help people out. And so that's really what we're talking about today is how can we find ways to continue helping people?
That is so true. So why don't you, Cheryl, after working for Northwestern, why don't you tell us a little bit more about your career path and how we started talking again, and you giving me some great advice on the expertise that you've learned over the years as well.
Sure. Like I said, Northwestern was sort of our start where you and I met. I was an advisor at Northwestern Mutual. And after Northwestern Mutual, I joined Nuveen Investments as a vice president of their wealth management services team. And there I was really focused on topics that were more complex, helping advisors have very challenging conversations with their clients. So I would develop content in the area of retirement income or women's financial planning challenges, basically any kind of topic, estate planning issues, family wealth issues. And I really worked closely with advisors in learning what the challenges of their clients were. And so at Nuveen Investments, I developed a great expertise in those topics. From there, I went to TIAA. And at TIAA, I was a director of the integrated solution. So what I did is I really coached advisors and help advisors, again, with their most complex clients, understanding how to take advantage of annuities, life insurance, managed income solutions, all the different products that our institutions have created to help clients. I really helped educate the advisors on how to use those products the right way for their clients, and then how to communicate those benefits to clients. So from that, after 20 years of really coaching advisors on how to be incredible, I decided, why not just do this on my own? So in October of last year, I decided to make a change and become an independent coach and help people be incredible through coaching and clear communications.
So Cheryl, I have used some of your presentations that you created over there at Nuveen. And one of the things I liked about how you've presented in the past really is that you're able to take some really complicated subjects and make them much easier to consume for advisors and clients alike. And so today we're going to take one of those complex subjects of charitable giving and how to do it in times like today. This would have been a different conversation last year when everybody was feeling really happy about their portfolio values being super high. This year, it's like, we know we need to still be charitable, but it's harder for us all to do.
Absolutely. We are seeing when markets are good, there are plenty of options. You have disposable income, excess disposable income to spare. You have highly appreciated stocks, things that are easy to give. And you feel much more generous because when you're doing well, you want others to do well too. But when we see periods like what we're seeing right now, where you've got high inflation, volatile markets, sort of an uncertain economic future, people are very concerned about what's the next 12 months are going to look like. People are really hesitant on how and where to give. What I find interesting, though, is that as a society, America is a really generous society. In fact, about 90% of affluent people give. And of that, 60% of millennials, 60% of Gen Xers give. So it's not just the baby boomers, but 70% of people have decided to kind of pull back on their giving this year. And a lot of it is because of the uncertainty, but a lot of it is because they really don't know what to give. And so I think there are some really tax smart ways to be generous in 2022. And that's what I'd like to really share with you today.
Absolutely. And to clarify, because the water is so murky and looking at the next 12 months, it's probably not just for 2022, but 2023 as well.
Absolutely. Absolutely. So, and as you start planning for 2022 and how to give, I do think looking into 2023 matters. In fact, when I think about giving and some of the challenges, I think the challenges that people are facing right now is when to give, where to give, and what to give. So speaking of 2022 and 23, the when to give challenge is one that a lot of people are struggling with right now, especially when they're thinking about what the markets are looking like and when is the most tax advantageous time to give. Have you ever heard of this thing called bunching?
I have heard a little bit about it, but I'm not that familiar with the strategy.
You know, one of the things that happened post-COVID is there was this new rule, this IRS rule that requires you to itemize your deductions in order to take advantage of any charitable contributions that you make, in order for those to be qualified deductions. So if you don't have enough deductions to itemize, then your charitable contribution doesn't get deducted. So one of the ways that you can get around that challenge is by bunching 2 years of giving into 1 year to overcome any standard deduction challenges.
And that right there, I see being really challenging for retired clients who are a lot of times are just taking the standard deduction and can't meet the amount of deductions it would take to actually do the higher level contributions and deductions.
Exactly. You see a lot of retirees, they end up sort of being forced into taking the standard deduction. They don't have the mortgage interest. They don't have the same level of deductions as a younger person would have. So for them to be able to take advantage of the charitable deductions, it's going to be a little bit more challenging. So let me walk you through. Can I walk you through a kind of a scenario? And by the way, I'm going to be posting these. These are available. I have my blog, which you can find on beincrediblecoaching.com under Incredible Thoughts. I've got a blog that kind of lists this out, and the charts are there as well. But when you think about bunching charitable deductions, let's say, for example, an individual has a desire to give $10,000 a year to charity. And let's also assume that other taxable deductions are like $15,000. Their total deductions are only $25,000. When they go to do their taxes and they look at their standard deduction, the standard deduction is $25,900. So instead of itemizing, they take the standard deduction. And then next year they do the same thing. That's not a bad idea. It works out fine. But the IRS rule allows you to say, instead of giving in both 2022 and 2023, how about I give twice as much in 2022 and nothing in 2023? If I do that, then all of my deductions actually become more than the standard deduction in 2022. So now in 2022, I get to itemize. And in 2023, I take a standard deduction. That creates a tax advantage for you over a 2-year period. Now, one thing to clarify, you can decide to take 2 years of deductions in 2022, and it will benefit you for 2022 and 2023. Or you could decide to to bunch 2 years in 2023. So 2 years worth of deductions in 2023, and that'll benefit you for 2023 and 2024. So the timing doesn't matter. Just know that you're taking 2 years in place of one. 2 years worth of deductions for 1 year.
Okay, so that's something that would be really interesting for our listeners today, whether they do it for 22 or save that money and push it into 2023. Either way, you want to double the contribution for the 2 years. That's what you're saying.
Double contribution for year one and then zero contribution for year two. That means then that in year one, you get to take an itemized deduction of the higher amount. And then in year two, you won't have a charitable deduction. So you'll take the standard deduction in year two, but it'll give you a greater tax benefit.
Okay, that's great. And does this example expire when the IRS rules go back to, what is it, 2026?
No, this rule has been made permanent. It had been made permanent pre-COVID. Okay. And then during 20 and 21, it was, they did away with the rule. So they said that anybody could take a charitable deduction, even if you were just taking the standard deduction. But now, beginning in 2022, they've reintroduced and made permanent the rule where you have to itemize in order to recognize that charitable deduction. So the only way to really take advantage of the charitable deduction is to have enough deductions to itemize. But if you don't do that, consider bunching 2 years of donating into 1 year. And then that'll throw you over that standard deduction amount.
And I'm guessing then that this is something that you could repeat 2 years later. So if somebody bunched all of their 2022, didn't do any charitable contributions in 2023 as part of the bunching, that they could do this again in 2024 and continue doing it as long as they can take advantage of it.
Exactly. You're exactly right.
Very cool strategy. So, Cheryl, then there are a lot of other clients and listeners out there that maybe have reached the age of 70 when they can do something else, when they have their IRAs and their required minimum distributions. Can you speak a little bit about that as well?
Sure. So what you're referring to are qualified charitable distributions. So for people who are over the age of 72 and are subject to required minimum distributions, if you are also wanting to give to charity, instead of just writing a check out of your checking account and sending that to your charity, you might want to consider sending part of your required minimum distribution directly to charity. Because if you do that, then you bypass having to recognize any of that as income for tax purposes. So let's say, for example, you've got a required minimum distribution. You're over 72. You have a required minimum distribution of $60,000. And again, you want to give $10,000 worth to charity. You could take that $60,000 in required minimum distribution, pay the taxes on it, which, by the way, would be about, somewhere around neighborhood of $14,000, $15,000, and then take that after tax amount and send off $10,000 to your favorite charity. And then you keep the rest of that income. But if you actually instead have, let's go back to the example, you have a required minimum distribution of $60,000 and you want to give $10,000. Let's say you say, I want to send $10,000 directly to this charity of my choice. Then I can take that, and then you'll take the other $50,000 in required minimum distribution for yourself. You're only paying taxes on the $50,000 as opposed to the full $60,000. By doing that, you can give significantly more or save on taxes. The example that I showed in my blog shows a $3,400 tax benefit by sending money directly to the charity from your RMD instead of taking that in cash first.
That's a great strategy for people who have to take distributions, who may not necessarily need the money or the income and are already contributing to charitable organizations as just part of their, yearly outlay, or at least as just because they're nice people. I had two questions on that, Cheryl. Number one is, does the charitable contribution that's being made directly to the charity for meeting that required distribution, does it need to happen before the end of the year, or is it based on the tax deadline?
Okay, so contributions have to be made by end of calendar year. Contributions to your IRA can be made up through the tax filing date, but any contributions made to a charitable organization have to be made by 12/31 of that year.
Okay, that's great clarification, because we are approaching the end of the year. So if you are looking at wanting to do this, most people would have already done the required distribution by now, but it's a good strategy. It's something to think about, especially if you're someone who does contribute to charities and doesn't have a real need for that required minimum distribution, because they're meeting it from other, they're getting income from other sources, or dividend, or Social Security.
Yeah, and I will add to that, because I've seen a lot of times mistakes being made on tax returns. Although I'm not a CPA by any means, I am a little dangerous when it comes to taxes, and I can spot a mistake when it comes to these qualified charitable distributions. So be careful with them. The 1099 that you get from the custodian of the IRA will just say you had a $60,000 distribution. It won't account for that $10,000 contribution that went directly to the charity. So make sure, if you're working with a tax professional, you let them know that money, the $10,000, went to that charitable organization, or you won't get that tax benefit.
Okay.
One other clarification on this with the qualified charitable distribution. Anyone over the age of 72 who is subject to required minimum distributions can gift up to $100,000 of the required minimum distribution directly to a charity. That cannot go into a donor advised fund to qualify for this, and the limit is that $100,000. So those are two really important things to note on the QCD.
Okay, great. And then my second, because I said it was one of two questions, my second question to you is, does it need to be liquid funds? Could it be stock holdings? Could it be an actual investment that gets directly paid out to the charity?
Yeah, so your distribution, however you take that distribution from your 401k, your qualified account, it can be the stock. But if you think about it, the main benefit of giving a stock directly to charity is because of the tax benefit if it's in a non-qualified account, in like a brokerage account. From a qualified account perspective, it's just as easy to liquidate and send directly, or have the company liquidate and send cash directly to the charity. So in a qualified account, it doesn't matter how they receive the assets. It's probably just as easy to be cash. Does that make sense what I'm saying?
Yeah.
Yes. Thank you.
There's certainly a benefit to sending stock directly to a charity if it's non-qualified money or after-tax money. The benefit of giving stock directly to a charity in a non-qualified account or in a qualified account doesn't really exist.
That's right. So that brings us to another subject of giving and what to do this year when we don't have that highly appreciated stock in our taxable account. So you want to talk a little bit about that now?
Yeah. So, I think it's interesting. It's like, what we were saying before, people are so generous, and especially when the markets are going well, and people have highly appreciated stock, they're really comfortable with gifting some of that stock to charities. But when markets are volatile and we're experiencing sort of this bear market and we don't have a lot of highly appreciated stock, there are still some really good things that you can do. For example, you can sell depreciated assets, depreciated stock, and then send the cash proceeds to charity. So think about this. When you have stock that's highly appreciated, you want to give the stock directly to the charity. And do you know why that is?
Yes, because we don't have to pay those capital gains.
Get out of paying the capital gains. But on the other side, if you have a stock that has lost value, if you give it directly to charity, is there any benefit of them receiving the stock directly as far as being able to offset those losses in any way?
No, not at all.
No, the only way you can take advantage, so to speak, and I'm using air quotes as I say that, advantage of a loss is to first sell the asset. So let's say you have stock XYZ and it used to be worth $5,000, but today it's only worth $1,000. And you want to give $1,000 to your favorite charity. What you could do is you could sell that stock and get the $1,000 back and claim $4,000 in that loss to offset another gain, which is a tax advantage, and then turn around and write a check for $1,000 to the charity and then count that as a contribution. You're now taking advantage of the full original value of that investment from a tax perspective, giving and then taking that loss and offsetting other gains.
That's so interesting because I tend to think sometimes people don't want to sell the stocks that have a loss, especially if they don't need those funds. They just think, well, why don't we just wait for it to come back? But if you're already going to be giving to a charity, then it makes sense to actually just sell it, take the loss, and give the proceeds to the organization.
And then those proceeds are also that's a charitable deduction, right? So you're getting another tax advantage. It's all about giving the right thing to the right organization at the right time, and it benefits you both. And doing things this way benefits you both from a tax-wise way.
That's right. And it speaks to what we started the whole program with, was just taking some of these complex concepts and just finding ways that people can take advantage of them. And a lot of it has to do with just having the information and the insights to be able to make better decisions. Because in many cases, I think people might already be doing this. They just don't know that they could possibly be doing it smarter.
Right. And we seem to be having a lot of conversations here. I know with our CPA professional advisors that are working with shared clients of ours to just really go over, what are the advantages of taking maybe some capital losses this year, or is it better to take it next year? We have some really cool tax planning software that we just acquired this year. And by seeing some real live examples, I can tell you it can really impact a whole lot of issues besides just the charitable contributions or taking the losses per se. It may bleed into your capital gains rate for the year, or it could, if you're retired, it could have some impact on what Medicare premiums you're taking. But there's so many things that are variables in your tax return that impact so many other areas of your financial life that seeing it all in one place is so important.
Yeah. There's this one other really cool strategy that I want to share about that I think is good for people of all ages. And I think about young investors, people who buy stocks that they are, really passionate about, and they make them part of their portfolio. And then that stock continues to do well and it continues to grow, and they love the stock. They don't want to sell it, but it's got these terrible, terrible capital gains in it, and it's becoming a huge tax burden. There's this really cool strategy with a gifting strategy that allows you to think about donating that stock and then rebuying that stock to reset your cost basis. So you can take advantage of well, can I walk you through a second?
Sure.
Let's assume that you've got someone who wants to give 10,000. I like the number 10,000 because it's easy to work with. I'm not really a mathematician, so I'm going to stick with 10,000. Let's assume you have a stock that you bought. XYZ originally was $1,000 and now it's got a fair market value of 10,000. And let's also assume that you've got a budget to give $10,000 to charity. Okay. Now you can write a check for 10,000, or you could give this XYZ stock. But the problem is you really like this XYZ stock, so you want to kind of keep it in your portfolio. If you, though, instead give that stock to charity, then the $9,000 long-term capital gain gets forgiven, right?
Mm-hmm.
Then taking the $10,000 that you had set aside for charitable gifting and then use that to repurchase $10,000 worth of that stock you just gave away. Now your cost basis in your portfolio is $10,000. You've increased your cost basis, wiped out a tax liability, and kept your allocation for that stock the same. So I know a lot of people, there's a lot of people I talk to who have inherited stock and they love that stock and they don't want to give it up, but it's got terrible gains. This is a wonderful way to make it much more attractive to hang on to that stock for the long term.
That is such a great idea. It seems so crazy to be buying a stock, giving away a stock and then buying the same stock. But I can see where it would be such an advantage from a tax standpoint.
Yeah. And there is the thing called the wash sale rule. A lot of people are afraid of doing this because they think about the wash sale rule. But the wash sale rule, are you familiar with what that rule is? I'm sure you are.
Yeah, we are. And from time to time, we come across it.
Yeah.
So
for our listeners, though, that are unfamiliar with the wash sale rule, what is it?
So you cannot sell a stock and take a loss on it and then buy it back within 30-day period.
True. But there's nothing that says you can't sell a stock for a gain or give a stock with a gain and buy it back at that higher price. So wash sale rules only applies to losses, not to gains. That's what makes this really cool strategy work.
It's almost as the reverse of a wash sale situation then.
Exactly.
Very cool. Well, Cheryl, those are some pretty interesting conversations we should be having at this time of year, and any time really, is to think about your charitable wishes and how they map into your investment strategy. Is there anything else we can take advantage of?
One other thing, if I could, this is so much fun, by the way. I love, the fact is, because we all do want to give, we just don't always know how. One other thing I want to bring up is this idea of building out a diversified giving portfolio. Have you ever heard of anything about diversified giving portfolios?
So this is a really interesting topic because I've never thought through my own giving. I just give to organizations I like. And I've heard different messages about giving. And one is, give more to one organization instead of multiple organizations because you can make a more meaningful impact. But then it's really difficult to do that because there are so many big needs out there that I want to give to. So tell me a little bit about that.
Yeah. And to your point, kind of giving to one organization or one cause because that's, you feel that you can have a greater impact. I like to think about a diversified giving portfolio the same way I think about a diversified investment portfolio. It helps spread the risk. And I say risk because, if you were to say, I'm going to give all my money to this one organization, and if that one organization ends up not doing what you wanted it to do the right way, it would really be disappointing. When I think about giving to nonprofit organizations, it's just like making an investment into a stock. Not all not-for-profit organizations end up making it or being able to do what they aspire to. And so if there are causes that are important to you, I think when you have a diversified giving portfolio, it almost gives you permission to think about giving some money to some more of the riskier charitable investments that have a greater potential. Like you want to help something get off the ground. You don't want to give them all of your money, but you want to help them get off the ground. It's a wonderful way to kind of give yourself permission to do that, as well as support some of the more well-known organizations that will take the money and throw it right into the cause the way you want it to. So it spreads your impact and your opportunity to help other organizations grow. Does that make sense to you, though?
Yeah, it does, because one wouldn't think about the risk giving to a charitable organization, but I'm sure the larger donors do consider this. And that's probably the reason why you see all these match donors where if I give to one organization this month, then somebody's going to match that. So my impact is bigger.
Yeah, I'll give you an example though. For example, I'm doing some work with my local community foundation, and my local community foundation offers grants to not-for-profit organizations that are local. And but they do it through a process. Those organizations have to apply for those grants. As I read through these grant proposals, I realize how many not-for-profit organizations are potentially, some of them are struggling just getting off the ground, and there's some risk to them. So finding a donor who's willing to invest in them is key, but that is a risk from us. If you and I think about gifting, we're more prone to go to those organizations that we know about. But if we think about creating a diversified portfolio, when I have my diversified investment portfolio has a certain allocation to higher risk investments because I know the return potential on those are greater. Wouldn't it be cool to consider a charitable investment portfolio where you carve out a certain amount of your charitable gifting to those who are a little higher risk, those organizations that are smaller, trying to get off the ground, because the return potential on those are so great. That's the idea of building out a diversified portfolio.
I like the idea. I think it's great. And I do remember reading stories, especially during the pandemic, that many people started funding or at least shifting their contributions towards those organizations that were more focused on health and healthcare, because they were, we were in the middle of the throes of a pandemic and we didn't know, what the next 6 months or even the next year was going to look like. And that started affecting, some other charities that were normally, receiving these contributions. So I love this idea because I think it puts either the organizations like these foundations, or in the case of an individual, an opportunity to redistribute or distribute these contributions that they're making across those organizations that might have the greatest need. And I know that we have a local community foundation here in our town that does exactly that. You can contribute to individual organizations within the foundation, or you can just make a contribution to the foundation itself, and then they will do the decision as to who they fund and how they allocate those budgets to make sure that all of the organizations stay afloat.
That is so interesting. And I fully understand this situation. And perhaps for some of our listeners that may be involved with some of the smaller nonprofits out there, understanding that whole process of giving grants to not just the larger organizations, but taking risk on the smaller nonprofits that may be able to make a great impact in the future is so valuable. There's so many things here where we have the potential to be incredible. Cheryl.
Yes, be incredible. That's right. And I do think, again, when the markets are going great and when everything's wonderful, it's so easy for us to give, but it's not hard for us to give even when it's years like 2022. We just have to be a little more creative in the way we think about giving.
And it's still so important. In fact, it may be even more important to be giving this year. While I was just reading an article in terms of more people struggling financially this year because of inflation and seniors having to skip meals and so many sad things going on out there. I constantly am reminding myself this year, it doesn't matter if I have to dig deeper into my purse strings to give to other people, because there are a lot of other people that need it so much more this year than myself.
Absolutely.
So Cheryl, as we wrap up and before we let you go, if you wanted to share, you mentioned a blog. I'm sure you have a website. If you can share some of those information for our listeners, if they'd like to do a little bit more digging and look you up, what would be their best resource for that?
Sure. For anyone who'd like to know more about me and what I do, you can go to my website. It's beincrediblecoaching.com. I also have a blog on that site under Incredible Thoughts. There is a blog on tax smart strategies to be generous for 2022. And it lists out all the strategies that we talked about today, along with a couple of others.
Thank you, Cheryl. There are so many ways to be incredible, isn't there?
Yes, there is. Always.
And all of these things will be placed in our show notes. So if you are really interested in these concepts and want more information, be sure to check them out at the Tech Girl Financial Podcast website, as well as for those of you who are our clients and listening to this and friends, if there's something you want to go over on these ideas and strategies, we are always here to walk you through this information with real life scenarios.
That's right. And so we want to take this opportunity, especially in the holidays, during the holidays, in the spirit of giving, to thank Cheryl for joining us on the Tech Girl Financial Podcast and sharing her ideas and insights and all these great strategies to help with the complexity of giving and better tax planning.
Thank you, guys. It was so much fun to spend time with you. I hope that you have happy giving experiences going forward.
Thank you. You too. That was a really informative conversation with Cheryl Rudd. And one more thing I want to point out for clarification, as we were talking about charitable giving in the IRA accounts, even though you are forced to start taking money out of your IRAs at the age of 72 now, you can actually start these charitable contributions from your IRA at age 70. And that is because it used to be 70 and a half when we had to start taking these contributions, forced contributions, the RMDs. And so just wanted to let you know that if you're 70 and maybe don't need to take the money out, but still want to be charitable, it may be in your best interest to do it from your IRA.
Good to know. Good to know. I'm not quite there yet, but.
No, you aren't. And for all of those of our listeners that aren't quite there either, enjoy. And that we do have some wonderful strategies for you to It is not entirely too late, but it has to be done quickly this year. And these are concepts that will be still good in 2023. So we realize that it's late in the year. There aren't too many market days left available for us to make changes. But please give us a call if you want to walk through any of these scenarios, and we are happy to walk through it with you.
Yeah, and if it's too late for this year, I mean, it's good to at least start thinking about the charities that you want to make contributions for next year. The idea of bunching, which I think was really good, which would basically take 2 years worth of contributions. So you may think about doing that in 2023 if you couldn't do it for this year in 2022.
Whatever you do, just give is our message.
just give. I guess that's the bottom line is, if you're going to be charitable, just be smart about it, but give. So again, we want to thank Cheryl for joining us on the program and sharing her ideas for charitable giving. So on behalf of everybody here at Tech Girl Financial, including our team, Kim, Mika, Christina, Nano, and Juanita, the cat and the dog, we got to include them. We want to wish everybody a very happy new year, and we can't wait to come back in 2023 with all new shows. Happy New Year.
Happy New Year.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgirlfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the Tech Girl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. Tech Girl Financial and Cambridge Investment Research, Inc. are not affiliated companies. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.